Putin's advisor is right. We're going to devalue the debt, but not by printing stablecoins, by activating the 3.7 trillion in the sterilized reserves, by creating 3.7 trillion in treasury demand, by exporting the inflation globally. And when is this going to happen? Well, Scott Bessent said by 2030, but I think it's going to happen much faster. What are you and I going to do about this? Well, simple. Sort of like the central banks, we don't hold cash, we don't hold US dollars, we don't hold US treasuries, we don't hold fiat currency. We're holding hard assets. We're holding gold. We're holding Bitcoin, of course, minerals like lithium, right? They've all been doing great. Real estate works. But of course, Bitcoin's my favorite because it moves the fastest when liquidity expands.
Imagine waking up and finding out the dollars in your wallet quietly lost 40% of their value in just 4 years. You didn't spend them, you didn't invest them. They simply bought less because that's how the system works when money gets printed at historic speed. Mark Moss points to this exact problem drawing from what Anton Kobyakov, one of Putin's top economic advisors, said at the Eastern Economic Forum. According to Kobyakov, the U.S. is deliberately reshaping both gold and crypto markets, nudging the world toward what he calls the crypto cloud. Whether or not you buy that narrative, the pattern is clear. Monetary resets happen every 40 to 50 years, and by the calendar we're due. But unlike past cycles, the U.S. doesn't need to seize gold or hammer out new agreements. The modern reset lever is simple: expand the money supply. Between 2020 and today, M2 grew from $15.5 trillion to $21.9 trillion, a staggering 40% jump. The fallout is everywhere: housing up 50%, gas up 50%, insurance up 70%, food up 30%. That's not ordinary inflation. That's deliberate devaluation. And while the debt burden shrinks on paper, $37 trillion worth, other nations are waking up. China, Japan, and others are selling treasuries. Foreign ownership of U.S. debt has fallen from 34% to 23%. Just like in 1971, the system is creaking under its own weight. Something has to give. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that actually understand what's unfolding. Thanks for watching.
Back at the Eastern Economic Forum, again, Anton Kobyakov. And remember, this is Putin's senior economic advisor, right, for over a decade. Now, he's been in the room for every major Russian economic decision. He's laid out this theory. Again, he said the U.S. is trying to rewrite the rules of the gold and crypto markets. His exact words were that America's ultimate goal is to push the whole world the US into moves what he called 37 trillion national debt. Think about that into these digital assets. And then he's saying once the world's money is wipes the slate clean, while everyone else is holding the bag. But here's why this matters. This isn't just some conspiracy theory from our enemies, right? He's been architecting Russia's economic strategy since 2012. So when he speaks, it's not speculation. It's what Russia's leadership actually believes. And like I said, he's kind of right about devaluation. He's actually dead right. The U.S. absolutely plans to devalue the debt. Now, we've done it before. We've done it actually multiple times. But I think Russia just misunderstands it a little bit, right? They think we're going to create stablecoins out of thin air like we print dollars. But that's not how stablecoins work. It's actually way more powerful. So let me show you what's really happening. 1933, Executive Order 6102. President Roosevelt, he doesn't ask Congress. He doesn't negotiate. He signs one piece of paper, the executive order, and boom, confiscates America's gold at $20.67 per ounce. And then what happens? Overnight, he revalues it to $35 an ounce. Now, if you do the math, that's a 69% devaluation. One signature, 69% is gone. Think about what that means. You had $100 in savings, and now it buys you $31 worth of stuff. But the government's debt, they just got 69% cheaper to pay it back. Now, it's not the only time it's happened. It's happened many times since then. If we fast forward to 1971, President Richard Nixon closed the gold window. He basically rug pulled the entire world by removing the gold backing of US dollars. And since then, the dollar's lost 96% of its purchasing power. 96%. Again, 1985, the Plaza Accords. We had 5 countries get together and agree to, again, devalue the dollar by 25% in 2 years. And it worked. A 25% devaluation. It was coordinated. It was planned. It was executed. So when Russia says we're about to reset the system again, they're looking back at history, right? They see the pattern. They understand why it has to happen. Now, about every 40 to 50 year cycles, they see this coming due, and right now, we're due. But what they're maybe not understanding so much is that we don't need gold confiscation this time, right? We don't need international agreements. We have a new mechanism, and it's already in motion. How do you devalue dollars when you're not on a gold standard? Well, it's simple, right? You just continue to expand the money supply. If we look at the M2 chart, just from January 2020, we had $15.5 trillion. Today, we have $21.9 trillion. That's a 40% expansion in just 4 years. 40% in 4 years. If we look at everything else, gas prices up 50%, home prices up 50%. The median home in America costs 50% more. Pretty interesting. Property insurance up 70%. Gold 35%. Bitcoin, it's up over 250%. See the pattern? When you create $6 trillion, new dollars out of thin air, but you don't create any new houses, you don't create any new oil, any new anything, right? Then the prices start to adjust. The dollars start chasing the same goods and prices go up. So your grocery bill, food's up, right? 25 to 30%. Steak, milk, eggs, it's all up 30% plus. Now that's not inflation, it's devaluation. Your dollar buys you less. And here's the key. That $37 trillion of debt, it's still $37 trillion on paper. But what does $37 trillion buy today versus what it bought in 2020? It buys 40% less, right? The government just cut the real debt burden by 40% without paying back a single dollar, right? Without having to default, without having to negotiate with anybody. They just printed the way out. But here's the problem. The world, of course, sees this, right? It's not that China and Russia don't understand this. It's why China's dumping treasuries. It's why Japan's dumping treasuries. It's why foreign ownership of U.S. debt dropped from 34% to 23%. Sort of like when Nixon had to close the gold window. So the U.S. needs new buyers of debt. Cue it in, enter the stablecoins. Russia thinks we're going to print stablecoins like we print dollars.
Congress may have just rewritten the playbook for stablecoins. Mark Moss points to the Genius Act passed this year, which forces every stablecoin to be backed by cash or U.S. Treasuries, no exceptions. That's a dramatic change. The era of minting tokens out of thin air is gone. Now each coin must be anchored to either physical dollars or government debt. On the surface, that might look like it limits Washington's ability to inflate away obligations. But Moss says the real move isn't about printing more, it's about locking in automatic demand for treasuries. Every new stablecoin issued now feeds the market for U.S. debt, keeping the government's borrowing machine humming. Bitcoin and broader strategic reserves enter the picture from another angle. Moss argues the U.S. government doesn't need to buy Bitcoin directly with taxpayer money. Instead, it relies on the private sector to take the risks and build the scaffolding first. That's how SpaceX won contracts before NASA retooled and how Intel landed subsidies under the CHIPS Act. The same pattern is unfolding with Bitcoin through MicroStrategy ETFs and corporate adoption. The government can step in later, reaping the benefits without shouldering the early risk. Let's get back to the interview.
Now, the Genius Act that was just passed this year, it mandates every stablecoin must be backed by U.S. Treasuries or cash. No exceptions. Okay, so wait, if we can't print them, if every stablecoin needs a real dollar behind it, then how do we devalue the debt? Right? How does this actually help the U.S. government? This is the part maybe Russia doesn't seem to get, right? They're thinking about it just a little bit wrong. It's not about printing. It's about what those dollars are doing and where they're coming from. You see, when you give Tether a dollar, they don't just put it in a vault. They go buy U.S. Treasuries with it. When Circle gets a dollar, same thing. They go buy Treasuries with it. So this creates a perpetual demand for U.S. debt. Now, the more the stablecoins grow, the more the Treasuries they have to go buy, right? It's automatic. It's built into the system. But that's just part one. The real trick is where those dollars are going to come from. And that's what I want to show you. If stablecoins need real dollars, how does this help the U.S.? Well, it's simple. Every stablecoin issuer has to buy treasuries. That's the law under the new Genius Act. You want to issue $1 billion in USDT? Well, you need $1 billion in T-bills. If you look at the numbers right now, Tether's holding $127 billion in U.S. treasuries. Circle holds $55 billion. Combined, they're the 18th largest holder of U.S. debt globally. Bigger than Germany, bigger than South Korea. And where it starts to get interesting is Scott Bessent, he's the Trump's Treasury Secretary. He projects stablecoins to hit $3.7 trillion by 2030. China's been dumping treasuries down $1 trillion to $756 billion. Japan's selling. Foreign ownership dropped from 34% to 25%. But stablecoins, they have to buy it, right? It's required. Every dollar that goes into USDT or USDC becomes demand for U.S. debt. So that person in Argentina trying to escape inflation, they buy stablecoins, USDT. That business in Turkey avoiding the lira, they use USDC. They all become treasury buyers, right? They're funding the deficit without even knowing it. $3.7 trillion in guaranteed treasury demand. That's the plan. Now, right now, U.S. banks have $3.2 trillion sitting at the Fed, right? This is excess reserves. This is money that's been parked there since back in quantitative easing, back in 2008 for 14 years. And it's kind of like dead money, right? It can't be lent, right? It's not in circulation. It just sits there earning IOER or interest on excess reserves. And that's about 0.5%. And here's the mechanism. The Genius Act says that banks can use these Fed deposits as stablecoin backing. They could take $1 billion in excess reserves, back $1 billion in stablecoins, and it's the same money. But now it's moving. $3.2 trillion. Right? That's been frozen since 2008, but now it can start to enter the market. Not new money, the same money, but just moved, activated. Now, when the 3.2 trillion starts circulating, prices start to adjust, right? The dollar starts to weaken. The $37 trillion in debt, it starts to get devalued, but not through printing, through activation of reserves, right? That's maybe the part Russia seems to misunderstand, right? We're not creating more money. We're unleashing what's been trapped. Now, if we look back at the rest of the world and what they're doing, we can see that they understand that. Now, what about Bitcoin? What about the strategic Bitcoin reserves everyone's talking about? Well, the reality is Scott Bessent, Treasury Secretary, he kind of killed it, right? He said, quote, no taxpayer dollars for Bitcoin. So the SBR bill, is it dead on arrival? Well, think about it this way. In 2022, the CHIPS Act, it passed. And the reason why is because the U.S. government needed semiconductors. But did they just go buy Intel stock? No. They gave Intel $50 billion in subsidies and grants, and then they took warrants. They took an equity position in Intel. It's the same playbook here. Look at this pattern here. Private innovation happens first, like SpaceX goes and builds the rockets. Then NASA contracts them, right? Amazon goes and builds AWS, and then the CI uses the servers, right? We have the private sector takes the risk, and then the government is able to use or capture the value. So the strategic Bitcoin reserve, maybe it's not dead. Maybe it's just not happening the way you think. Maybe it was never going to work the way that you thought. Maybe we're already building the Bitcoin reserves through companies like MicroStrategy and Marathon and Riot and through the ETFs. Maybe the government just hasn't taken their cut yet. All right, but let's just bring this all full circle, right? Putin's advisor is right. We're going to devalue the debt, but not by printing stablecoins, by activating the 3.7 trillion in the sterilized reserves, by creating 3.7 trillion in treasury demand, by exporting the inflation globally. And when is this going to happen? Well, Scott Bessent said by 2030. But I think it's going to happen much faster. Stablecoins are growing rapidly. As a matter of fact, they grew 32% in just 7 months. So at that rate, we're going to hit 3.7 trillion by 2027. And of course, the world sees it coming. That's why gold's at $3,700 an ounce. That's why central banks bought 4,000 tons in 4 years. That's why China is buying gold and not U.S. treasuries, right? The reset's happening. It's not an event. It's a process. All the pieces are being put into place right now. The Genius Act, it's already law. The reserves are already there. The mechanism's already in place.
Think about it this way: when money itself becomes the tool of policy, every paycheck savings account and retirement plan is caught in the crossfire. What looks like steady inflation on the surface is really a slow confiscation of purchasing power. At the same time, legislation around stablecoins isn't just about regulating crypto. It's about hardwiring demand for government debt into the digital economy. That keeps the treasury market alive even as foreign buyers step back. Meanwhile, private companies are being nudged into building the rails of the next financial system, with Bitcoin playing the role of a parallel reserve that Washington can eventually embrace without getting its hands dirty at the start. Put together, this isn't a patchwork of random events, it's the outline of a deliberate transition. The question isn't whether the dollar standard changes, but how and who gets left holding the bag when the dust settles. If these shifts accelerate, will ordinary savers recognize early enough that the ground is moving beneath them, or will they only realize it once their dollars no longer function as the world's measuring stick? So stay tuned. If you're into real data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Thank you for the support, and I hope you enjoy the video.